Stop everything you're doing right now, completely. If your mouse was about to click another tab, if you were scrolling alerts, if your mind was planning the next task, stop. Hold still. Do not move. Because what you are about to witness is not a rumor. It is not speculation. It is not some vague prediction from a self-proclaimed market prophet. And it is absolutely not random noise from the financial world. What I am holding is something far more disturbing. It is a ghost, a document that was never intended to see daylight. This is a confidential directive, a top-level internal memo issued from the deepest inner core of one of the most powerful investment banks on earth. This message comes directly from inside Morgan Stanley. More specifically, it originated from their commodity trading division, the control room, where billions of dollars are shifted in milliseconds. This memo was circulated just 72 hours ago. It was sent exclusively to Morgan Stanley's most elite institutional clients, hedge funds, sovereign wealth funds, and ultra-high net worth individuals who sit at the absolute summit of the financial pyramid, the top 1% of the top 1%. And buried inside this document are 3 words capable of stopping your heart. Exit all positions. Pause and absorb that phrase. In high finance, language is surgical. Every word is selected with precision. They did not say reduce exposure. They did not say rebalance. They did not say prepare for volatility. They said exit. On Wall Street, exit is not a suggestion. It is not advice. It is an evacuation order. It is the command issued when damage control is no longer possible. It is what you hear when a ship cannot be saved. It is what you hear when a structure is collapsing and the foundations are already failing. Morgan Stanley, a financial giant managing approximately $2.3 trillion in client assets, is ordering a full abandonment of the silver market. Not gradually, not partially, completely. And they have attached a hard deadline, the end of this month. This is not caution. This is panic at the institutional level. This is the smartest minds in the room realizing they are standing on a live explosive. And their calculations show they have days, not weeks, not months, but days to escape before detonation. I have personally reviewed this memo. I have verified its authenticity through multiple independent sources embedded deep inside the institutional trading infrastructure. What follows may be the most critical piece of financial intelligence you encounter this year, possibly far longer. When a bank like Morgan Stanley runs, it means its proprietary risk models have identified a threat invisible to the public. It means something catastrophic is approaching, something that will permanently alter the precious metals market and divide those who acted in time from those left behind. You now face a decision. You can dismiss this as hype. You can label it exaggeration. You can tell yourself this is just another false alarm. Or you can recognize what is happening behind closed doors on Wall Street, the financial equivalent of watching rats flee a sinking ship. Smart money always knows first. It always maps the exits before the water reaches the floor. So let me show you what Morgan Stanley sees. Let me explain why they are fleeing. And most importantly, let me show you what must be done before this evacuation becomes public and the exits disappear. The memo itself is shockingly brief, only 3 paragraphs, but every line is lethal in intent. When billion-dollar clients are being told to dump positions, there is no room for soft language. The first paragraph identifies the technical trigger. It states that due to extreme volatility and, this is the key phrase, structural changes in the silver derivatives market, Morgan Stanley is advising all institutional clients to close every long and short position in COMEX silver futures, futures options, and over-the-counter silver swaps. Structural changes is Wall Street code for one thing. The system is broken. When structure fails, the rules that once governed the market no longer apply. It is like being informed that the bridge you cross every day has developed invisible fractures, and engineers can no longer guarantee it will hold even a single vehicle. You don't slow down. You don't reduce weight. You shut the bridge entirely. The second paragraph injects urgency. It states that this directive applies to all position sizes and all expiration dates. Then comes the most chilling instruction. Clients must prioritize orderly liquidation over price optimization. In plain language, this means we do not care about losses. We do not care about bad prices. Just get out. Sell into whatever liquidity still exists. Whatever happens at month end will be far worse than realizing losses now. That deadline is not arbitrary. It represents a mathematical boundary. Morgan Stanley knows multiple events are converging, events that will make holding silver positions lethally dangerous. The third paragraph is the true shockwave. Morgan Stanley declares it will reduce its own proprietary silver exposure to 0 within the same time frame, and will accept no new silver-related business until further notice. Understand what that means? Banks exist to earn fees. Trades generate revenue. When a bank refuses business, it is deliberately destroying its own income stream, walking away from millions, possibly billions, of dollars. Banks only do this when survival is at stake. Morgan Stanley has concluded that whatever profits silver generates are not worth the risk of that desk endangering the entire institution. To grasp the gravity of this, you must understand how such a memo was created. Banks do not casually alarm clients. Every word would have been vetted by lawyers, compliance teams, and senior risk officers. It likely reached executive leadership. Telling clients to exit creates massive legal exposure. If the bank is wrong, lawsuits follow, reputations collapse, clients disappear. The fact that this was still issued tells you everything. Internal models are screaming. The numbers were run. And the conclusion was clear. Warning clients is less dangerous than staying silent. The probability of a catastrophic silver event before month end is unacceptably high. So what do they see? Morgan Stanley's commodity desk has near perfect visibility. They see real-time institutional order flow. They see what JP Morgan, Goldman Sachs, and Citibank are doing behind closed doors. They track physical metal because they operate inside the global supply chain. They are not guessing. They are not reading headlines. They are physically moving millions of ounces of silver across borders. And right now, their screens are flashing red. They are watching 3 crises collide simultaneously. First, inventory collapse. COMEX registered silver has fallen below 32 million ounces, the lowest level in over 10 years. 6 weeks ago, it stood at 41 million ounces. That is a loss of 9 million ounces in just 6 weeks, roughly 1.5 million ounces disappearing every week. Recently, the pace accelerated. In just 14 days, another 4 million ounces vanished. If this continues, registered inventory reaches 0 in under 2 months. Skeptics point to the 230 million ounces in eligible inventory. But eligible silver does not belong to the exchange. It belongs to private owners with no obligation to sell. With premiums exploding globally, they will not sell at paper prices. Eligible silver is locked. Registered silver is the only real buffer, and it is evaporating. Second, delivery demand. Silver has always been a paper market. Hundreds of paper ounces trade for every physical ounce. Historically, about 95% of traders never demand delivery. That ratio is breaking. Last cycle, 9% demanded delivery. Next estimates, 12 or 15%. With 160,000 open contracts representing 800 million ounces, a 15% delivery rate requires 120 million ounces. Only 32 million exist. That is mathematically impossible. The exchange would be forced to settle in cash. At that moment, paper prices die. Third, counterparty risk. Beyond exchanges exists a shadow market with 5 to 10 billion ounces of notional exposure. Many entities are short metal they do not own. As physical prices diverge, losses explode. Banks scramble for collateral. One failure triggers contagion. Morgan Stanley sees the first domino shaking, and they are stepping away. These forces feed each other. Inventories fall. Fear rises. Delivery increases. Vaults drain. Shorts panic. Prices spike. More buyers rush in. Premiums explode. Paper credibility collapses. The loop accelerates. Morgan Stanley's models show we are already inside that acceleration. Their data says the exit closes at month end. Not opinion, mathematics. They have seen this movie before. 1980, rules changed overnight. 2008, early exits survived. 2022, nickel trades are raced to protect insiders. The lesson is clear. When systemic risk appears, you do not wait to be right. You leave. That is precisely why clients were warned. Legal insulation and a controlled withdrawal. Morgan Stanley needs time to unwind positions methodically without triggering an instant market detonation. Retail investors glance at silver trading near $30 and assume stability. They have no awareness that the largest players are already halfway through the exit. By the time the retreat becomes obvious, the doorway will be clogged. Once Morgan Stanley accelerates its unwind, volatility will erupt. Shorts being closed will drive sudden price spikes. Forced liquidation of longs will smash prices downward. Stop-loss orders will cascade. Bid-ask spreads will fracture. $27 bids facing $32 asks. Market makers will effectively step back. When the dominant player stops caring about price, market structure disintegrates, and that is exactly the environment Morgan Stanley is preparing for. We are entering a liquidity death spiral, and the clock is no longer measured in months. It is measured in weeks. As month-end approaches, a decisive separation will emerge. Under normal conditions, paper silver and physical silver move together. They rise together. They fall together. But during systemic failure, that bond snaps. Institutions dump paper exposure to survive, and the linkage between the two prices breaks. You may witness the paper spot price decline. At the same time, the price of actual physical silver may hold firm or climb. Owners of real metal will recognize the disorder and refuse to sell. The result is a warped reality where the official price reads $30, yet dealers demand $50 or more. That gap is not an anomaly. It is confirmation that price discovery has collapsed. This is exactly why Morgan Stanley is instructing clients to exit everything. They understand the quoted price is about to become a fiction. If you hold a paper contract, what you truly possess is a promise, and promises fail when systems fracture. Inside a financial giant like Morgan Stanley, month end is an uncrossable boundary. It is the moment of total exposure. On the final day, banks must perform mark-to-market accounting. Every position is revalued and locked onto the balance sheet. Regulators and central banks scrutinize these numbers. If silver positions show extreme losses, capital ratios deteriorate. If those ratios fall too far, credit ratings are downgraded. Funding tightens, confidence evaporates. By forcing all positions closed before month end, Morgan Stanley is executing a balance sheet purge. They want to report one fact: zero exposure to the silver collapse. This is also why clients are being pushed out. When a major client fails, the bank often inherits unpaid margin debt. Clearing exposure now insulates the institution from what follows. You are currently living in the gap, the narrow window between when smart money recognizes imminent failure and when the public finally feels it. Turn on financial news and everything appears calm. Commentators debate rates and employment. This is the illusion of normalcy. Beneath the surface, massive silver positions are being quietly dismantled. You will not hear about this memo in mainstream media. The same interests exiting the market also shape the narrative. They require liquidity. They need participants to remain engaged long enough for them to exit without collapsing prices prematurely. In every major financial failure, the public message is identical. Everything is fine until it isn't. Morgan Stanley is not waiting for headlines. They are responding to data. And the data says the orderly phase is over. So what do you do with this? First, stop thinking like a trader and start thinking like a risk manager. Identify your exposure. Do you own silver, and in what form? ETFs and unallocated accounts or paper claims. In a structural breakdown, paper fails first. You could wake up to forced liquidation at an exchange-mandated price. Second, recognize the conversion window. You have roughly 3 weeks, possibly less, until month end. The objective is to convert as much paper exposure into physical control as possible. Premiums are irrelevant. Institutional logic prioritizes certainty over discounts. Paying more for reality is preferable to paying less for something that can vanish. Third, monitor the red line indicators. Track COMEX vault reports daily. If registered silver falls below 25 million ounces, the system enters the danger zone. At that point, exchange failure shifts from theory to probability. Fourth, prepare for violent and contradictory price action. Paper prices will behave erratically. Short covering will send prices sharply higher. Do not celebrate. Forced liquidation will crush prices. Do not panic. If you hold physical metal, ignore the screen. The only price that matters is the cost to replace what you own once it disappears. Some will remain skeptical. They will argue banks reposition constantly. They will say silver squeezes have been predicted for years. That is the skeptic's trap. The belief that because something has not yet happened, it never will. But reality disagrees. The nickel market broke. Regional banks cracked. Silver is smaller, thinner, and far more leveraged than both. If Morgan Stanley's models are telling them to abandon a profitable desk, the system has crossed a threshold. Consider the asymmetry. If you move into physical silver and nothing dramatic occurs, you still own a tangible asset. If Morgan Stanley is right and you stay in paper, the downside is total loss. The risk-reward equation is clear. When the smartest players are sprinting for the exit, you do not debate. You move. Beyond this memo, a global pressure cooker is building. For decades, Western markets relied on paper silver to suppress price. That framework is breaking. In the East, especially China and India, demand for physical silver is relentless. Metal is being bought at suppressed paper prices and sold into higher physical markets. This vacuum is draining exchange vaults. At the same time, silver has become a critical industrial input. Renewable energy, electric vehicles, advanced electronics, and defense systems all require silver. The world is already in structural deficit. Paper can be created endlessly. Metal cannot. Morgan Stanley is stepping aside because they refuse to stand inside a failed exchange. We are entering the final chapter of the old silver market. Inventory status will shift from available to delayed to unavailable. Shelves will empty. This will not unfold slowly. It will happen abruptly. If you hold paper silver, a decision stands before you. If you hold physical silver, you are already positioned. Do not let paper volatility frighten you into surrendering real assets. Those who retain ownership through this transition will carry purchasing power into the next system. Morgan Stanley has effectively issued an early warning. Information separates outcomes. The exit door remains open, but movement has begun. Do not wait for the surge. This is not a sudden shock. It is the documented end state of a system pushed beyond its limits. Morgan Stanley is out. Their clients are leaving. The only variable left unresolved is you. The clock is running. When the month closes, the paper bridge disappears, and only what you physically control will remain.